Good morning, Matthew, sir.
Good morning, sir. Good morning.
Yeah, over to you, sir.
Thank you, sir. Thank you so much. Hello, everybody, and good morning. Welcome to this edition of this webinar by Aditya Birla Sun Life Mutual Fund and powered by the Week. Some of you have been with us for long, and welcome back. And those who are here for the first time, welcome. It is lovely to have you all of us with us here on a Sunday morning. Thank you for taking the time to be with us today. Today's topic is art of investing and edge of asset allocation. Two major topics are being dealt with. One is the fundamentals of investing and the essentials of asset allocation. A couple of things before I start. Usually, the Azibullah family puts out links and downloadables in the chat box. Please do look at them, download them, and use them. They are quite useful. I'm speaking from personal experience, and it's a lovely resource to have, and it's free. Please use it. And if you have any questions, please put them in the Q&A section. Mr. Rao and the other members of the panel, Mr. Amit Trivedi and Mr. Vinod Bhatt would be happy to answer you. And in case we don't take up anything because of the paucity of time, usually Rao sir makes it a point to answer it personally on mail, so don't worry about that. Before I start, I also quickly thank those who are at the back end from the ABSL family, Subhashish and Rushali, and from the week and the Malayalam Manorama, Mr. Sri Kumar Menon, Sri Devi, and Rahul. Thank you so much for all the support. And my duty this morning is to welcome our panelists. I am Matthew P. George, a news editor of the week. And this has been a very long journey with ABSL MF. It's been a personally enriching journey with lots of friends in this. So for me, this is like home. This place is like home, and I hope you also feel at home, and I'm sure you will feel at home. Let me start off by welcoming our guru who hands all this together, Mr. K.S. Rao, who is Executive Vice President of ABSL MF, head of their Investor Education Department and Distribution Development Department. Welcome, Rao sir.
Thank you
Rao
so
sir
much.
is over Ravsar has over 34 years of experience, 34, 35 years of experience in the field, very seasoned veteran. So much so that ABSL itself has designated him as a role model for youngsters within the company. So you will benefit from that advice. He's a IIM Calcutta alumnus, MBA in finance, a chartered wealth manager. One thing I always say is that, course correction has never been a thing that he has been afraid of because he started with dairy and ended up in finance. And that takes a lot of courage. So, very courageous man also. And when I talk about him and Amitji, who has been with us for the longest time on this panel, I always say that more than investment advisors, they are wonderful human beings, lovely fathers, very responsible sons. It comes through when they talk about their families. So this is not just about professional expertise that they are offering, but life lessons and what they, as good human beings, have been able to do through their life. So once more, welcome Rahul sir to this seminar. Thank you so much. Again, it's my pleasure welcoming Amit ji. Amit ji is our mix of Amitabh Bachchan and Amir Khan and Kapil Dev and Virat Kohli and everything together. He spans a wide range of finance, of cricket, of Bollywood. He speaks the language of the people. We say that, in India, three things are very important. Religion is important, cricket is important, and films are important. And he is quite clued in on all of that. He is head of Karmayog Knowledge Academy. One thing that we usually do is that we discuss books when all three of us get together, and others like friends of theirs like Ms. Kiran Talang and others get together. So for me, it's a great learning experience also. And a cost is involved when I talk to them because often I get off here and go to Amazon and order something. So, so that is also, there was a very, very pleasurable experience. I always take away something from this. He's an author, a speaker, a trainer, a blogger. Blogger before blogging became very popular, and he became a Fin influencer before Fin influencers became popular. So on many accounts, he's a pioneer. And though this book has been a little while, about 1 to 2 years since it came on, Moneywise Perspectives for Women, co-authored by him and Ms. Kiran Talang. That was the latest book. Please do buy it and read it. It's a wonderful book. And for all of that and for being with us for so long, thank you, Amitji, and welcome to this
Thank you.
session this
Thank you.
morning.
Pleasure.
It's my pleasure to also welcome Mr. Vinod Bhatt, who's been with us before, but maybe not as frequently as Amitji has been. But it's a great pleasure to have you with us, sir. He's a portfolio manager and equity strategist at ABSL AMC. Has over 2 years of 2 decades of experience in the sector, with 15 years in financial markets and investment banking. Formerly, he was VP Group Strategy and Business Development at Aditya Birla Management Corporation, and before that in the US with Credit Suisse and Ocean Park Advisors. He's an MBA from Wharton, and like Rao sir, made a career switch quite early in life. Was started off as an engineer and from graduating from IIT Bombay and also from Penn State, and then came into finance. So they are role models in how courageous people they are, and when they thought that a shift should be made, they went ahead and made it, both of them. So Mr. Bhatt, thank you so much for being with us this morning, and welcome so much on behalf of ABSL and the Manovarga
Thank,
family.
thank you. My pleasure, sir.
So with these words, let me hand it over to Rao sir. The schedule is as usual. Rao sir has a presentation, then there's a panel discussion between the three of them, and at the end of it, there's a Q&A that we take from the audience. And as I said, if your question doesn't get answered, don't worry. Rao sir doesn't answer here, but he'll answer it offline. So please stay with us till the end, and over to you, Rao sir. Thank you.
Thank you so much, Matthew sir, for this wonderful introduction of all of us. And more than the words, the pleasantness you bring, and it starts with an optimistic note, and you pass on those vibes to all of us on a Sunday morning. And we also apologize every month, at least one Sunday, we
Not,
make you to skip the church and come
not at
to
all,
the
sir.
webinar.
Always a pleasure.
And I'm sure Lord Jesus will forgive for that and bless all of us. And
Sure, sure.
and
Thank
indeed,
you.
it's my honor to be with Amit ji and Vinod ji this morning. And I sincerely thank both of them for making their Sunday available. And I also thank the Manorama team for making this happening over years, and the continuous effort, Sri sir and entire team, women and everyone, we are highly grateful. And last but not the least, I am very glad. Good morning to all the audience who joined us today, either through the Zoom or through the Facebook live or the YouTube live. And at Aditya Birla, this is our 30th year of in the business of wealth creation, and we are grateful to every investor of us and every prospective investor for us. And at our whole intention of this webinar is to month after month is to ensure that we get you the best possible updates, and as neutral as possible, and zero of any products of our fund house or any fund house. It's a conversation to connect with each one of you and also clarify whatever the best we can do during the webinar otherwise. And between last webinar to this webinar, there is a little gap, a month. We have May is a month, May and bit of a June beginning was a month. It is not only hotter months for us, but these are the months of the seasons of IPLs. We had three IPLs I look at. The first IPL is the cricket IPL, which we had engrossed full. And it's the Indian Premier League. And the second IPL we were engrossed was India's political league. Once in a 5 years, we have this play and we have this results. And both the IPL's results are a bit different than anticipation. And I come from a Bangalore family. Then I call. We always support the local Bangalore RCB. We expect them to come. Every save time we say, "Isala cup namade," and we also go back and say, "Isala tappu namade." Tappu is mistake is ours. Similarly, it happens at both ends. And then the third IPL at Amphi and all the fund houses, we all work towards this IPL is. Mutual fund Sahi Hai, which has created a lot of wealth, which we call Investors Prosperity League. And we are getting this IPL is going to be a long-term lifetime. It is not engaging, not entertaining, but it is empowering, and it is creating the wealth and is ensuring that all of us get prospered. Like financial Shikshit Bharat Banega Vikshit Bharat. And we are also helping that financial Shikshit, as well as financially you stay invested. And last presentation to this time, there are a lot has happened. I will not take much. It's I mean, we had the gyrations in the market, which we will have a conversations with both the experts. So one is an online expert, one is offline expert, and who is on the field expert. Vinod ji comes with that, and Amit ji comes with a, I mean, broad purview. And market seems to have shaked off those elections result concerns, and now it is marched to all-time peaks. And returns across the various market cap segments in the past few years have been good, but with the mid and small caps are outperformed. And this is the time volatility in the frontline indices we can see, and everywhere it is I mean, it's a trading at above the historical averages. And at this environment, probably it's a time for us. Probably June is a month we send our children back to the schools after a summer vacation in most of the states, and it is a time for us to go back to that school to revisit our fundamentals. And one need to be cautious, one need to moderate the return expectations. And what is that this period of time, what are those fundamental law which is governing our investment returns, and how much risk we are taking, what is the return we are getting, whether we are truly there to the asset allocations. And when we are outsize the returns, then it's a time for us to, can we relook at a portfolio. All that you can do with your in consultation with your financial advisor. Probably all that we discussed today is to help you to have those conversations much more better. I mean, to proceed further, what I do is quickly I'll run through a small presentation. Then I'll have these two experts coming to us, and we will have those conversations around, and to keep that context alive and to keep us engaging. I'm sure, I mean, all of you who are going to spend next 60 to 75 minutes, we try to give our best. And any of your questions you have, please put it in the Q&A box. And rest of the conversations can still go on the chat. My colleagues Subhashish and Rushali, they are putting on the chat sections those downloadables. We produce a lot of content. You can visit our website. Our investor education website is the most sought after website in the country, and you can download those booklets, and there are engaging contents. We recently started a gamification part, and you can, and a quick maybe another 10 minutes to 15 minutes, I'll run the presentation. Then we will have a very engaging conversations. Please stay and give me a minute. Amitji, it's visible, right?
Yes, sir. Yes, sir.
Yeah. Thank you so much. Yeah. Friends, thanks once again, and thanks to our panelists. Thanks to each one of you for joining us this morning. And today, we will have these conversations. First of all, always we need to remind, reclassify. I mean, why do we personally save or invest? And last few days, it is a matter of concern for me. I mean, wherever I go, now I listen a lot of conversations. The conversations are to the extent I had a privilege to meet very professional bodies, and the conversations are about the trading and the markets. And I also keep meeting, traveling in the, the public transports and the airports, the conversations about the markets. And anytime these conversations are happening, and I'm little scared, little worried. We all go by the behavioral biases. Just a while ago, Mr. Bhatt was talking to us. All those things which are coming in. But basically, we should not forget why we start this journey, and to have a comfortable life, and why we invest. What is a broader theme for which you are investing? Is it the wealth creation? Is it you want to create a legacy? But don't forget, don't go by. I also have a stories which may not have a time to share today, but these stories of a lot of people who have lost huge money in the trading markets, and which is not meant for truly meant for retail investors in such a way. Until and unless you are well equipped and you are highly knowledgeable, I'm not saying I'm nothing against of anything, but all I can say is we need to be on the path. We need to have that GPS, and we need to drive that safe, because better safe than the sorry factor later. And we all have these aspirations. We invest for aspirations. We want to maintain a good wealth and good health, and we want to leave a legacy. Our investing purpose is just to make our life better and make our investments work for you, and so that we will have a peaceful life. It's a, I mean, somebody said very nicely, if you want yourself visible after 1 decade, what is the, if you want to be seen after 1 decade, the way you are today, all that you need to follow that SEEN. What they say is, you should have those sound sleeps, you should have that right exercise, you should manage your emotions well, and N is, you should have a nutritional diet. Similarly, for your wealth, you need to have, after investing, that should not take away your peace, that should have a nutritional diet like a proper asset allocation, and you should not become victim to the emotions, and you need to have, that exercise of caution always you need to do. And why we do what we do is, we do it because
Rao, sir, you got muted.
oh,
So you,
sorry, sorry.
yeah.
Yeah,
No, no,
you
I'm
no.
might
sorry.
have muted.
I'm extremely sorry. It is auto muted. I don't know. And thank you so much for reminding that. This is the art of investing is wise management, and it is hard-earned money we have. Our earnings, I mean, it's hard-earned money, and you need to invest it right, and you have a regular savings. And part of the money we invest, part of the money can go to charity. But all that, risk versus returns, how much you need to look at. And I mean, we should not forget one thing: our pre-work for investing. And work for investing can be done by our fund managers like Vinod Bhattji, and advice comes from the financial advisors. But what pre-work we can do is why we are investing. What is that distinctive investment objective which you are looking at? What is suitable for you? How you need to look at things in a very, very different perspective. And then, whether your investment is working for you. Is that investment fighting the inflation? Are you getting a right income? Is the money is available to you when you need? Is your assets are growing? And can you realize that money at a quick click of button? And every investment got a purpose. Every investment vehicle is a purpose. Are you using the right investment vehicle for the right purpose? If you are investing in equity to create wealth, mutual funds can give you multi protection. Whether you want to create a wealth, whether your 1 day money, your 100 years money, you can have this mutual funds as a vehicle. And whether you're, and then where you are putting your fixed income, and whether you are capitalizing the opportunities of the tax saving opportunities. Have you planned for your retirements? Have your insurance is right? And these are the basic rules of investing. How you need to look at, it's a, I mean, how you need to rebalance your investments. Whether you are investing rightly into the various asset classes. Is it according to your risk tolerance? Is it according to, what is the art of risk management? Can you avoid the risk? Can you reduce the risk? Can you transfer the risk? That is a ART art. And what is that art you have? How you are rebalancing it? And some problem with my system. And it's like, history shows that you don't know what the future brings in, and future is unpredictable. I think we had multiple seminars where we spoke about when you can't predict, you all that you need to prepare. How you prepare is the most important. Successful investing is, it's a proven investing, during whichever the market cycles, the asset allocation. But some people keep complaining over last few years, if your asset allocation has minimized your returns, that we will have a debate and conversation with Vinod Bhattji. I mean, it is optimized returns, but it safeguards you better the asset allocation. And asset allocation is most important any period of time. More so when the markets are at peak. It is like, this is a period when you are running on the super highways, when you are driving at 100 speed or 120 speed. That is the time you should not forget to have your seat belt. Similarly, asset allocation is like your seat belt. And what kind of asset allocation you have? You have in assets which can grow in value. You can invest in assets that can generate income. And mutual funds can bring a combination of both, whichever the one you want. There is a mutual fund which can help you. Mutual fund is an investment vehicle which can support you. Don't need to look else. And what kind of edge you can look at? I mean, we call this EDGE. It can give an edge to you, but that edge is equity, debt, gold, and real estate, or international equity, whichever the way the other equity you can look at. Look various asset classes, what kind of percentage you need to have. We can have this conversation again. You know, Incidentally, we know G has written a wonderful book on, it's a marathon for your financial independence is a marathon. You need to continue. And he himself is a fund manager and he is a marathon runner. Similarly, I have Amit Ji, who is a author, speaker, and also currently his company is a OSAT, one step at a time. Probably I call him as a one sip at a time. We will have these conversations around this. But basically, one should not forget asset allocation will not enhance your return, but it will have a downside protection. When things are going faster at speeder, you should not crash into the accident, and where it can give you those protection. It will help you for that long-term wealth creation. In the process, what it can give you is the peace of mind. You may have sometimes minimized your returns, but it can give you that peace. You can relax at it. And there are, like, if you are looking at in the first week of this month, there is a gyrations in the stock market. There is, like, we have seen like a pre-election rally, and then you have those expectations. Then there is a huge drop. Then there's a government which can have a very, very different, then after that again markets have settled down. Probably these gyrations, what has happened from third, fourth, fifth, and fifth is incidentally we celebrate World Environment Day. But let us discuss how the market environment, how that investor psychology played, and how that could have impacted. Probably we will have some practical lessons of understanding from our good friend Amit ji, and he can converse to us. And how these gyrations have given the discomfort, and how the volumes have spread in the market, how the markets could not, people could not place these orders. There is a period of time. How the euphoria has played, how the fear has played. That day, that time, it is different. Today, connecting the dots could be much more easier. And this is not for the first time such things happen. History always repeats. I love this book, second book of the Morgan Housel, the same as ever. Certain things in the past, certain things in the present, certain things in the future. It's always the same, but we different, we act differently. Probably that's the lessons we need to learn. Stick to our investment philosophy, and for investing purpose, then we should not lose that money. And whether it's it's a same government is voted out, and same government is coming back, but market reacted two times two different ways. And this is where in the past, and there are many such stories here. The it is your reality and the expectations. There is a gap which you can look at. And how these markets have played, how the pundits are talking about, how the individuals got impacted. However, let me not get into the politically right. And there was a period of time politicians are talking about the markets, and the market experts are talking about the politics. Whichever the way, I mean, we live in this tug of war, and we should have a strategy for the long run. We should ignore sometimes the short term. Short term gyrations are like your speed breakers. It will give a pass, but it will make you to move on. And we need to live. The best course of action is learn from our own past, learn from the masters. And here is some masters which we need to talk. But today with me, these are the two wonderful masters which we can talk. One of the masters, the story of Mr. Market, the Benjamin Graham. If you have read, probably I'll skip in a way this entire story. I mean, probably these conversations I'll have with Amit ji on this, how this Mr. Market can play, and what market can guide you is ignore Mr. Market, don't worry about, and stick with your own investment plan. That's where you can move on and move forward. And all that you need to do is why you need to focus on your needs and your financial goals. What is under your control, and what you can do. How much risk appetite you have, how much risk you can take. How you need to stick to your basics, and how the mutual funds can help you in this space. And there is a good part today is a mutual fund SIP book is growing and growing. That's a maturity in the investors, Indian investors. And thanks to the entire mutual fund fraternity, including our fund house and AMFI, the mutual fund SIA, which has really the true financial inclusion is happening. And the mutual funds is a way which has created a lot of wealth to the investors. I pray and I continue. I look forward. Investors will have that patience to continue their SIPs, even there is a period of pause which can come or which may or may not come. End of it, the psychology of investing. Again, I go back to Morgan Housel book. All that you need to do is you need to control your emotions. Controlling emotions is difficult, managing your emotions, understanding your emotions. And distraction should not rob us. And the distractions we can look forward. I mean, we can look at in a, it's called, we had some spiritual masters who came and addressed. They said you need to have this pratipaksh bhavna. You need to witness that, but you should not participate in that, so that you can look, it can go. You look at your IPS, that is it, your investing philosophy statement. And this conversations, all that we are doing under the aegis of SEBI. And any of your complaints or anything you get, our market regulator has created a scores website where you can look at. And incidentally, recently SEBI has also put fantastic investor education material. There are some quiz competitions. You have an app. Probably look at this website, and you can look at a lot to be done. And this is an investor education initiative from Aditya Birla in association with Manorama. And before I go, I say thank you so much. But I will invite our panelists on these conversations. And one message is SIP's momentum is on. And for me, that SIP should be that SIP, not just systematic investment plan. That is save wisely, invest it rightly, and plan smartly. Probably stick to these three, then rest of the things happens on its own. And with this, I'll stop my sharing. Then I will have my panelists coming in with me. Yes, and Amit ji will join us. And thanks once again for both of you. I mean, I just skimmed through the presentation. I thought better not to dwell it in detail, because when I have two of you who are the mirrors of the market and knowledge and the encyclopedias, let my presentation not take away much time from not skimming through both of you, but getting the deeper into you. Before I start, I think I'll start with both this question. I mean, answer can come start with G. We call some people call investing is an art, and some people call investing is a science. I know investing is an individual centric, but to just get the momentum on, is it an art or is it a science? Over to you, Vinod Ji.
Sure. No, that's a very interesting question. And in my experience, what I've seen is to become an investor, you can treat it as a science. That's what we do, right? Either we resort to fundamental analysis, technical analysis, or quant, for example. Right? So fundamental analysis means we try to evaluate companies, look at the business models, try and do the valuation, look at the management. Technical analysis, we look at various, charts and figure out whether we should buy or sell some stock or asset. And quant analysis, which is a new thing now, is to set up some rules and write programs and algorithms, right? So we try and convert investing to a science because we think that will help us to take the good decisions. But as we all know, wherever human beings are involved, there are biases, right? And that's where investing becomes an art. And to be a good investor, to be a really successful investor, one needs to treat investing as an art, right? And what that means is, like you mentioned, we need to be able to control our emotions, mainly greed and fear, right? And avoid distractions. And we all got a real life experience on June 3rd and June 4th during the election results, right? So when the exit polls were announced on June 3rd, we saw a big rally in markets. And, I was in Nagpur and Nashik at that time meeting with distribution partners, meeting with some investors. And I could see, some people on June 3rd, when the market was rallying, they thought that they had missed the rally and they wished that they had, invested more earlier. And on June 4th, the very next day, when there was a crash in the markets, everybody was panicking and they were wishing that they had sold some of their investments earlier and had not seen those losses, right? So whoever managed to control their emotions did well, and whoever couldn't took the wrong decisions, right? So just to summarize, to be a run-of-the-mill investor, you can think of investing like a science, but to be a really good, a successful investor, we need to think of it as an art.
Thank you so much, Vinodji, for such a wonderful example. I also believe, as you also put, there is a man, there is a machine, how the combination of this. Today, we are living in the world of artificial intelligence. I call use that AI, artificial intelligence, but also use another AI, advisors insights,
Correct.
because they learn with their past, they learn. And combination of these two, I think currently you are on the fund with man and machine, then that can be the one.
Yeah.
And
Sure.
over to you, Amit ji.
I think Vinodji, articulated it so well. There is a science behind it, behind investing, and there is an art of managing oneself, art of managing one's emotions. While you talked about from the portfolio management side, I'll look at it from the investor's side, and same rules apply. So first of all, there is some amount of science, some amount of math involved in arriving at the projected cash flow as to what are the financial goals, when are they due, how much money would be required, etc., etc. But in order to arrive at those numbers, we have to start with certain assumptions. So let's take a very simple example that I want to plan for my daughter's higher education, and the daughter is 3 years old. How do I know what stream of education she should pursue? A 3-year-old girl. So what do? I start with some assumption that she will take up a course which is reasonably costly. So If she takes up something which is less costly, I'm still with surplus money. But if I assume incorrectly that a cheaper course would be available and the actual expense turns out to be higher, then that's a mistake. So you start with those assumptions. Second, when it comes to assumptions, you also need to assume the rate of return, the rate of inflation, so many of these things. And once you've done that, all of us know that the investments do not follow a linear path. There are zigs and zags. There are major rallies and major crashes. And that's where controlling emotion becomes so important. I just came across one beautiful line, and because both of you mentioned about the market movements on 3rd and 4th June in particular. So this is not about the elections. This is not about politics. This is about investors. NSE recorded a huge turnover on that day. Why did that happen? Because people were, as Vinodji mentioned, trying to take advantage of the whole market gyrations. And in that process, I just read from Howard Marks' book, The Most Important Thing. Day traders considered themselves successful if they bought a stock at $10 and sold at $11, bought it back the next week at $24 and sold it at $25, and bought it a week later at $39 and sold it at $40. If you can't see the flaw in this, that the trader made $3 in a stock that appreciated by $30, you probably shouldn't read the rest of this book. So what happens in such cases is those short-term profits or short-term opportunities are often blown out of proportion. And when we act, we feel that we've done something miraculously good, whereas most of the time, investing properly in line with one's own requirement and then sitting tight and doing nothing is the base course of action. So from that point of view, sitting tight, sitting quietly is the art part of the investing, whereas working out those numbers, working out those calculations is the science part. Then also comes the selection of what kind of portfolio one needs to build for oneself. And there again, there are some rules that can be used, but again, you also use gut feel and you use your emotions. So to that extent, it's a good blend of art and science both.
Fantastic, Amitji. And friends, incidentally, both of them are great authors too. And one of the books of Amitji is Market is a roller coaster ride. For roller coaster to manage, probably you need to have a little bit of a science behind. And when Vinodji's book is a financial freedom marathon, you need to have a bit of a art how you can stay hooked and continue driving yourself in that marathon while managing the roller coaster. You have an art and you have a science. Coming back to the serious topic with both of them, and thanks to large number of people today participating through the Zoom and Facebook. I'm so glad to see. Probably I never realized if we give a 1 month gap, we get the number of people coming is doubling. Probably then I'll suggest Sri sir, we will have a bi-monthly webinar rather than monthly webinar. Glad. Vinod sir, now you are an author, you are an expert, and your philosophy of asset allocation, and you also manage asset allocation funds. And in your opinion, probably we want to learn from the of you. I mean, around the asset allocation. I mean, when this volatility we have seen on third, fourth, fifth, and before exit polls have come, everyone has entered, and real results are coming, everyone is exiting. And as earlier, I mean, the most important thing what Amitji was talking, people coming at 10 and exited at $9, or that's the kind of life which they are in. And this elections day, there's extreme volatility was there. And if somebody stick to that asset allocation, somebody stick to those basics, how would have been helped the person, those who are sticking to those basics rather than going by these gyrations of the market?
Sure. So just to explain with an example, I'm going to compare two investors. Let's say one investor has put all their money in just the equity basket. Okay, so they've only invested in equity mutual funds or let's say in stocks. And the second investor has done a proper asset allocation. So they have 60% allocation to equity through mutual funds and stocks, and let's say 30% to fixed income through fixed income mutual funds, and 10% to commodities like gold and silver, right? with some real estate also in the mix. Now, just taking that example of June 3rd, 4th, like if you look at an investor who is only invested in the equity markets, they would have seen extreme volatility in their portfolio, right? On June 3rd, they would have seen a big profit and they would have thought I should have invested more. And June 4th, very next day, they would have seen a big market correction, big losses in their portfolio. And most probably they would, many would have panicked and thought that maybe I should reduce my equity exposure, right? And they would have ended up taking wrong decisions. Whereas the second investor, because they have diversified across equity, fixed income, and let's say, gold and real estate, the volatility in their portfolio would be much lower, right? Because even if equity was going up and down, the fixed income portion and the commodities portion, the real estate portion didn't really fluctuate that much, right? So the volatility would have been much lower and they would not have experienced this kind of a greed and fear kind of emotions, right? So they would have remained much more stable and not had to worry about their portfolio. And at the end of the day, they would have been as well off as the investor number one, right? So the whole point of asset allocation, like we keep saying, is the diversification helps you because it helps you to overcome the volatility in the portfolio, right? So different asset classes like equity, fixed income, commodities, real estate, these are negatively correlated. So if one equity, for example, asset class is going up or down, maybe fixed income and gold are stable or they're giving better returns, right? So the overall portfolio will still give a stable return. And that's what we would want as an investor, right? I don't want my portfolio to give a big positive return in 1 year and then a negative return the next year and again a positive return the third year and so on, right? If I get a stable, consistent, let's say 12 to 13% kind of return every year, I'm most probably I'll meet my goals, right? If I have a longer horizon. And that's the whole point of asset allocation, that it helps you to preserve your capital as well as create wealth over the long term.
Absolutely. So thank you so much for that. I mean, sticking to your basics and getting the right asset allocation can make that happen. I mean, going back to you, Mitji, and on these market gyrations, I know, I mean, from the outside, I mean, you are watching a lot and, you are there. You're seeing that all the action, like it's a watching like the IPL on the last day and some disappointment, some, difficulties, and then you lose the match or somebody who has gained the match. It is like on third, like a dil mange more ya kal ho na ho, and then on the fourth, zindagi na mile dobara, like market will not happen like this. Everything has happened. These gyrations in the stock prices around that election results has caused a lot of damage to some people and created wealth to some, and some investors who are steady. Nothing has happened after 1 week. Everything has just gone back. In such situations, though in the past it's happened and currently, how one can avoid that and what investor can basically do with during that case, such times, when Vinodji said sticking to the asset allocation could have been the best thing to happen. But always, we go by the headlines and we look at our portfolios. And I have seen one disadvantage and one advantage. Technology has given a lot of advantage to get the transactions right for us.
Right.
And the portfolios are visible at every end of the day. In those days when the technology was not there, when I need to give my physical form, my statement of account coming to me and the form, there is a gap. During the gap, I have a period to think over. Right across, everything is on my palm and my app shows your NAV is up, down and markets up and down. Both sides I may, and most of the times it so happens, redemptions, people will click the button faster than the investments I have seen. And what is your advice?
So I have two stories to tell as an answer to this. Number one is the Mr. Market story that you had put in the presentation. So Benjamin Graham has apparently said about this story. And he said, assume that you are a partner in a business and your other partner is called Mr. Market. He said your business is generally stable and doing quite well, but your partner's mood swings are very, ridiculously volatile. So some days he is very jubilant, and some day he is acting like as if he's in depression. He says every single day, your partner, Mr. Market, comes to you, and if he's in a great mood, he wants to buy your share of the business at exorbitant prices. But just in case, if you are interested, he is ready to sell his share also to you. Whereas on some of the days when he is depressed, he would come to you and wants to sell his share at throwaway prices. But because he's your partner, he also makes a counter offer that in case you want to sell, I'll buy your share and relieve you of all the pain. Now, Mr. Market's mood swings are crazy, but his tenacity, his discipline is amazingly good. Every single day he knocks at your door, whether you accept his offer either ways or ignore him, he doesn't mind. Most of the times we have three choices. When Mr. Market comes to us, the first choice is we take the advantage of the moods of Mr. Market, which is when he is depressed, let's buy his share because he's selling it throwaway price. When he's jubilant, he's ready to buy my share at an exorbitant price. It's better to sell it to him. So that's choice number one. Choice number two, I fell prey or victim to his mood swings. And when he wants to sell his share at exorbitant prices, I will buy it. And when he wants to sell his share at depressed prices, I will sell mine. So I fall victim to him. And the third and the most important course, according to me, is to ignore Mr. Market on a daily basis. He says majority of us would be better off if there was no ticker tape. He wrote in 1940s, so he mentioned ticker tape. So he said most of us would be better off if there was no ticker tape. Today, technology has made that ticker tape available in our pockets on our mobile screens in front of us every moment. If we keep our ticker tape off, then the chances are we will be focused on the other important things like living life. And I think that living life is far, far more important. Investment, the role of investment, or the basic purpose of investment is to help us live that life of choice, not to ruin that life. And in order to do that, there is another story. I personally actually feel inspired by a frog. So there's this story of various frogs who were running a race, and at the end of the race, they had to climb up a pole. And whoever goes on the top of the pole would be the winner. And they started running towards that, and there were a lot of people cheering them. And then came the pole. So when the frog started climbing, the pole was a bit slippery. So a lot of them started falling down. So people started shouting, who were the bystanders who were watching, no, this is impossible, nobody can do it, impossible, nobody can do it. And still some kept trying. And finally, one frog would reach the top. People were wondering, such an impossible task, how does this frog win the race and reach the top of the pole? So as it happens in IPLs, there was a post-match presentation, and this frog was called by the commentator for an interview and asked the question, how did you manage to win when it was almost impossible? The frog did not answer. This guy asked a couple of times. Frog did not answer. Because the reality was the frog was deaf and could not listen to anything, the crowd's cheering or the commentator's questions. So if you keep your eyes and ears closed, then you can reach the top of the pole, and that top of the pole is our financial goals. Otherwise, there is too much noise around. Whether the prices are going up or on a daily basis, how does it change my life? If I have to put my daughter to a college, that college is still there. The building would be there. The fees I have to pay. I can't go and tell the principal that today the market is down, I'll not pay the fees. That is not allowed. And that's where what Vinodji was mentioning about a portfolio balanced across asset categories would actually help bring down the volatility of the portfolio. So if you can't completely remain deaf, take a portfolio which is diversified across asset categories so that those volatilities come down and the noise levels automatically come down. So call these portfolios as noise cancellation tools. And then you can reach the goals comfortably. So I personally don't really watch the markets on a daily basis. Like in case of the World Cup or IPL, you love to watch the highlights. So you already know the result, but you want to enjoy the game of cricket. So similarly, I love to watch the highlights of what happened in the market rather than actually watching at that point, because then you get too emotionally involved if you jump into the game. Stay away, watch as a commentator, as a spectator. Don't get involved emotionally into the games.
Bless, sir. Being an investor, stay hooked, and don't get involved. Focus on your investments and stay for long term. Stay for your goals. And I loved your story of a frog and the deaf frog. Probably there is a saying which says most of us during the bull market we are blind to the risks. During the bear market we are deaf to the opportunities. It's or vice versa,
Well said.
whichever it
Well
was.
said.
And moving back to you, Vinod sir, taking the clue from there, and asset allocation, it's like I mean, investors nowadays not created asset allocation. Have I gone in the last 2 to 3 years overboard on my equity? I would have made tons of money. But does that asset allocation protect the investors only from the fall, or is also controlling him to or her to not to get that kind of wealth in times of bull markets like this?
Sure. So, it's an inbuilt feature of asset allocation to reduce the volatility of the portfolio, right? So what it means is, if we take some concrete examples, let's go back to the COVID period, right? We all know that when COVID started, the equity markets fell in India by almost 45%, right? So investors who were only invested in equities would have seen a 45% fall in the value of their portfolio, right? And like, because I manage our Aditya Birla asset allocated fund of fund, I went through this experience myself. In the fund of fund, I have diversified across equity, across fixed income, across commodities like gold, silver, REITs, InvITs also, right? And I saw that the portfolio value fell by half, like just 20%. The market had fallen by 45%, but the asset allocated fund of fund value only fell by around 20%, right? And for the whole year of 2020 during COVID, when equity markets gave a negative return, the asset allocation fund of fund was flat. It did not give a negative return, right? So the important thing to understand is that asset allocation as a first step helps in capital preservation, right? That is the first thing we want as an investor, right? I want my capital to be preserved, right? The second step is then wealth creation, right? And there, of course, if the market is in a one-way momentum like what we have seen over the past 2, 3 years, then of course 100% equity portfolio will do better than an asset allocation portfolio, right? But over a cycle, like what we see is over a cycle of, let's say, 5 to 6 years, the market always goes through ups and downs, right? And over a cycle, an asset allocation portfolio will definitely perform as well or better than a pure equity portfolio, because it tends to kind of, makes things more stable, more consistent. And like I said, as an investor, what I want is a stable 12 to 13% per year kind of a return over a 5 to 10 year period, right? I don't want like a positive return one year, negative return the next year, a positive return the third year, and so on, right? So just to summarize, asset allocation will help us to preserve our capital and also to create wealth.
Thank you, sir. Thanks for it. Like, over a long period of time, when you are looking at short period, you look, I've lost that opportunity, but in another short period of time, you also look at, it is, you have not fallen as much as somebody has fallen.
Yeah.
That's the way it looks at. Coming back to you, Amit ji, I mean, probably the art of managing, I could get there, but I mean, the science of managing. I'll come back to the art, that is investor psychology. And how that investor psychology play a role. I mean, and and like we always call this mutual funds IEA, and sometimes mutual funds IEA, but not which funds IEA I don't know part. And sometimes also, like incidentally, from the day we launched campaign to till date, everyone has created quite a good amount of wealth. There could be a period of time, my entry and exit. I would have entered on a very wrong time, and it's a one-time investment. For me, it is not IEA. What is that I can do it? And like then how this there is an investor return, there is an investment return. How that plays in the mind of in a larger portfolio.
It is an interesting one. And for that, again, let me use an analogy from sports. So when I was in school, I used to play for my school's cricket team, and I was a bowler. Of course, at that age, at 12, 13 years, there was those dreams of eventually moving ahead and maybe even aim for playing for the national team. Now, when you're playing there, one thing that I observed there was we could simply place the ball in front of some of the fielders and trust that fielder to be slow in picking up the ball and throw widely and not on the target. So we could actually steal a run by simply picking up some fielders. It was easy because that was amateur cricket. You can't really steal a run from any of the international fielders. The skills are very different. So when you are playing the amateur game, you tend to lose points or you lose games. The champions play to win the game. Why am I mentioning this? Is because when I am an amateur, I'm not a professional like Vinod ji. And if I go and say, Vinod ji, let's engage in a duel. It's like going to Roger Federer and asking him, can we have a tennis match? I mean, he doesn't even need a racket to beat me. He can beat me without that. But most amateurs make the mistake of trying to beat the experts at the game that the experts are expert at. And in that process, we end up taking undue risks. Like you were mentioning, a lot of times we try to time the market and put a large lump sum amount. And most often we go with the hindsight bias. So we look at the recent past and make an entry at the wrong time. After the rally, we enter, or after the fall, we exit. Most people get into those kind of things. The best way to do is when you are an amateur and playing the game, stay in the game. Don't get out if you are a batsman. If you are a bowler, don't bowl no balls and wide balls. At least ball on the stumps. If you can stick to the absolute basics, and the absolute basics in the world of investing are simple: diversify, diversify, diversify. And diversification happens at multiple levels. So if you are looking at one asset category, you are diversifying across companies and across industries. When you are diversifying at the portfolio level, you diversify across asset categories and across geographies or across currencies. And on top of that, you can also diversify across time, which means you invest on a regular basis. So you don't really worry about catching the bottom. You keep catching the bottom and top both, but the benefit of rupee cost averaging will accrue to you at higher NAVs. When the units are costly, you end up buying fewer units. When the NAV is lower, you end up buying more units. Automatically, you turn the volatility to your advantage. So pick up a good quality portfolio, invest through SIP, diversify across asset categories, and then rigorously keep doing it. And remember the deaf frog. These are simple rules, but as they say, simplicity is the ultimate sophistication. And most of us do not suffer because there is artificial intelligence or AI. We suffer because there is exact opposite of AI, natural stupidity that all of us possess.
Fantastic, sir. Very rightly put it. Thanks, Amit ji. I mean, probably taking the clue from you, I'll go back to Vinod ji. I mean, Vinod ji, when Amit ji was talking about, he was talking about diversification and diversification within the asset category or diversification in the broadly. Probably mutual fund itself give an opportunity of a diversification. When I invest in one scheme, it is going to the various companies when I invest. And good part today in the mutual fund industry is there is a balanced advantage BAF and there is a multi-asset funds and but whether investor need to use the separate funds or there is a BAF and there is a MAF, probably what is the better way. And there is also a question which has come from one of the audience, Mr. Madhusudan. Incidentally, I had a privilege to meet this Madhusudan. He gives a lot of questions in most of the webinars. I met him in Chennai in one of the meetings some time back, a month back, and between BAF and MAF, how that can be chosen, and or there is an allocation fund. within this, there is sometimes a confusion, or there is a each meant for a different purpose. Probably you can have a little longer answer, but this can give a whole clarity about the industry as well as investor. As an investor, I can choose which one, whether I need to choose BAF, whether I need to choose allocation, multi assets, or like, I need to have my own, my equity investment portfolio is it, my debt portfolio is this, which is better way.
Sure. So, see, when it comes to asset allocation, there are two big decisions we need to take. So one is deciding in our portfolio how much allocation we should have to equity, to fixed income, to commodities like gold, silver, and to real estate, right? So that is one big decision. And then second is within each asset class, what do we invest in, right? Because even in equity, for example, we have large cap, and then flexi cap, large and mid cap, multi cap funds. We have mid cap, small cap funds. We have sectoral thematic funds. On the fixed income side, we have short term funds, low duration funds, long duration funds, government like GSECs, and so on, right? In commodities, whether to invest in gold or silver, right? So these are all important decisions which can impact the returns over the longer time frame, right? So if an investor wants to do this on their own, first of all, they should understand, what risk profile they are in. Second is they should have the time, interest, and the capability to do this analysis, right? So, for example, if I am doing a job, a full-time job, or if I'm running my own business, will I have the time to sit and do all this analysis? Then second, do I have the capability to do and sit and do this analysis, right? And third and most important, do I have the interest to do this, right? Because even if one of this is missing, I will not take the right decision, right? And that will impact my risk return profile over the long term. So I am always a proponent of keeping things simple, right? Because it's my full-time job to be, in investment management, to be a portfolio manager. I can, dedicate the time, interest, and capability to taking these decisions, right? But if an investor is doing something else, then it's simpler for them. It's easier for them to consider, for example, a balanced advantage fund, a multi-asset allocation fund, or an asset allocation fund of fund, right? Now, what is the difference between these? Now, a balanced advantage fund is the simplest step one can take, right? It gives you diversification across two asset classes, equity and fixed income, right? So for somebody who has only been investing in FDs, for example, or only in fixed income, they can come into a balanced advantage fund. It will give them some equity exposure along with fixed income. And there is a dedicated portfolio manager who keeps on adjusting the exposure to equity and fixed income depending on the level of the market. So the investor doesn't need to worry about timing the market, right? One step above that is the multi-asset allocation fund, right? Now there an investor gets exposure to 4 different asset classes: equity, fixed income, commodities like gold, silver, and real estate and infrastructure trusts, right? So the advantage there is the risk return profile is slightly higher, right? Because you are getting exposure to more asset classes, your return can be slightly higher than the balanced advantage fund, but the risk will also be slightly higher than the balanced advantage fund, right? So any investor who has already invested in balanced advantage fund, for example, and now wants to increase their exposure to equities to other asset classes, can consider the multi-asset allocation fund. A variation of that is the asset allocation fund of fund, where we invest not in stocks and bonds, but in other mutual funds and ETFs, right? So whatever an investor would do on their own or an advisor would do on their own, if they don't want to worry about the markets at all, right? If they just want to invest in one fund and get exposure to different asset classes through mutual funds and ETFs, then they can invest in the asset allocation fund of fund, right? So this is how the different solution, these are called, we call solution oriented products, right? Which are, the aim is to keep things simple for investors, right? So they don't need to track the markets on a daily basis. Like Amitji was mentioning, as an investor, if you have a long-term time horizon, best thing is to keep yourself away from the day-to-day gyrations of the market, right? Be deaf and dumb, like you mentioned, then you will be able to reach the top of the pole, reach your goals, right? And then if you don't need to worry about the markets and remain invested, you start with the balanced advantage fund, then you look at the multi-asset allocation fund and the asset allocation fund of fund.
Thank you so much for that clarity with the simplicity, sir, as always. And how the investor can look at BAF and MAF in a different segments depending on the different profiles. But these are the fantastic inventions from the asset management companies. And you just don't need to worry too much, and still you can create your wealth in over a long period of time with a lesser pain. Coming back to you, Amitji, I mean, when there are so many benefits of the allocation, and everyone speaks about, but during the tough times, people don't even remember why people will play and why most of us won't stick to the allocation, what we all, which is proven over a period of maybe almost 70, 80 years of the history. If we can look at allocation played the role.
There's this tendency in all of us actually, and that tendency was beautifully captured by a detergent company when they, came out with this lovely ad campaign which said, "Bhala uski kameez meri kameez se safed kaise?" Why that guy's shirt is whiter than mine? I don't really care whether my shirt is white or yellow, but somebody else's shirt happens to be whiter or yellower, then there is a problem. It's like I wanted to buy that Mercedes. I bought that Mercedes, and then when I was waiting at the traffic signal, a friend of mine came with a Bentley, and I was shattered completely. I can't enjoy my Mercedes now. Now, that's really where we do not have the eye on that goal that we want to achieve, whether I want to accumulate a certain amount for my retirement, whether I want to buy the house of my choice, whether I want to get my kids educated. Rather than that, I would worry about whether my neighbor got 12% per annum and I got 11.9. This is not a race, because unlike in the school exams when the kids have to worry about the results, that somebody getting 99 versus somebody getting 97 and the merit list changes completely. In the game of life, it is not the percentage returns, it is the amount accumulated that matters a lot. So if I have been saving 1,000 rupees a month, and if I earn 30% per year, as against that you've been saving 10,000 rupees a month and you earn at the rate of 12% per year, you would have more wealth than me. We don't really focus on what really matters, and the amount matters. We never sign a check in percentage, we sign a check in rupees for any goal. So how much accumulation we have done has to be the focus rather than the return. Now, that's where a fund which is diversified across asset categories will always underperform at least one part of the portfolio. So let's say if a fund is between equity, debt, and gold, at any point of time you take, as compared to the portfolio return, either equity or debt or gold individually would have done better. Now, if I keep comparing that my friend is invested in equity and he achieved so much and my portfolio has achieved only so much, that's not important. Do I have the wherewithal to go through that wild swings of the market, the roller coaster of the market? Incidentally, if you go to the any theme park where there are multiple roller coasters, people are more careful in choosing which roller coaster to ride, because some who want that extra thrill would go to those kind of roller coasters, and some who can't handle, they go to a more moderate kind of roller coasters. So we are able to choose it very carefully there. But when it comes to portfolio, the relation between risk and reward is often forgotten. The people who seek higher rewards have to live with higher risk, except the only thing that the finance theorists say is that diversification is the only free lunch in the market. But the counter argument is, in order to have that free lunch, you got to have extremely strong mindset that I will stay focused on that free lunch. And in that free lunch, if I don't get 2 pieces of sweets, I'll be okay, because those sweets would be somewhere else and you have to pay for that. If I focus on that free lunch, I think I'll be far better off.
Thank you so much, sir. When Amitji, follow-up question to you I can put is, since you spoke about the mindset, and since you also spoke about the emotions, and emotions play a bigger role than the market is playing in, how do one can safeguard against such emotions where I should not take into the action where I am getting into or getting out? And what is that investor need to do to process that emotions rightly so that they stay hooked to the investments?
No, I grew up reading the stories of invasions in India, and because I am Gujarati, and Gujarat was at the border, and we all know that Somnath temple was attacked multiple times. Now, in order to reach Somnath temple, the invader had to come via the desert. So I'll take the example of that desert. If you are going somewhere in that desert, you have to rely on your senses and maybe the ability to watch the sky and capture the direction properly. And then suddenly, if there is a storm in that desert and you have to run for cover, then you are lost. You don't know your exact position, where you are, and now which way you to go. So you can easily get lost. As compared to that, when the development started happening, of course, desert is still desert, and thank God desert is still desert. But a lot of cities now have roads or railway networks. And these roads and railway networks actually guide you about your direction, where you want to go. In the world of an investor, those rails and roads are the financial plan. Have a proper financial plan and you'll be guided completely as to which way you to go, which direction you to go. Now, when you are on that direction, when you are on that path, let's say you are traveling by train from Mumbai to Delhi, and the train stops in the middle for some reason, somewhere between two major stations. So it is stopped in a nowhere land. What are we supposed to do? And what do? We simply have to wait. There is no other way. We can't get down and find another vehicle. In markets also, the same things happen. There are sometimes places where the market stops. You don't get any returns. The portfolio doesn't seem to be moving. Even a diversified portfolio may deliver lower returns sometimes. And that does happen, and that's okay, because the long-term journey is to reach from Mumbai to Delhi. So first protection against the emotional turmoil is to have an investment plan. But then, because the rail tracks are physically laid and the financial plan is not physically laid, we are often like that kid in the candy store. When we see a nice candy over there, we rush towards that and we forget about the plan. And in order to ensure that we stick to that plan, a good advisor would play a major role in reminding us that's not your place to go. Stay here. Stick to this. Don't go there. It's like when to sportsmen, the coaches also keep telling them that, okay, don't, and again, I grew up in the test match era. So they would say, don't flirt with the balls outside the off stump. If you want to play a good shot, play a proper cricketing shot, but don't flirt with that ball. Otherwise, you're going to lose wicket. The coach actually is controlling the mindset of the batsman or the player. And a financial guide or a financial coach or a financial advisor is also supposed to be doing the same thing. Having said that, the financial advisor also helps in articulating the financial goals and prioritizing these goals, because there also the emotions play a major role. If I am a vice president in a company and my deputy, who is an assistant vice president, if that deputy sends his son to an Ivy League college in the US, then I should be okay if my child does not go to US for study and studies in a local college. We start comparing even there. The model of car that my assistant is using versus I'm using. Oh, that's my life, that's his life. So the guide would help, look at the consequences of setting incorrect goals. Because I start setting audacious goals in some of the less important aspects of life. The most important aspect of my life, which is my retirement, that may get compromised. A good advisor would guide there. And then, of course, in helping prepare that investment plan and then ensuring that we stick to that plan. So two major safeguards against the emotional turmoil: a good plan a solid plan, and a good advisor.
Thank you, Amitji, and it was fantastic, narrating with the journey. I mean, if you are in a journey of a train and if it is a destination where you want to reach, stay hooked into your coach and have your coach for you, the financial coach for you. Then you can manage the emotions. And with this, I'll stop and I will go back to Vinodji. And probably, Vinodji, before I take the questions from the investors, this question to you is your wonderful book, Financial Independence is a Marathon. And but in this marathon, we have a short-term goals and the long-term goals. And how do we need to have it, whether we need to have a different asset allocations or how we need to. It could be a 5 kilometer run or it could be a marathon run. How you need to differentiate between these two. And then I will go for the questions from the audience.
Yeah. So, see, just to continue the analogy of running a marathon, the idea is to pace yourself, right? Like if you try to run too fast in the beginning, let's say you run the first 5 kilometers too fast, then you will not have energy to complete your race in the end, right? Because a marathon is a long 42 kilometers. So it's similar when we think of our goals. If let's say I have a very short-term goal, let's say it's just over the next 2 or 3 years, then like Amitji was mentioning, I cannot afford to not have that corpus ready, right? Like I cannot go and tell the school principal that, can you give me 3 more months? The market can go higher and then I'll be able to pay my daughter's fees. That doesn't work, right? So if my goals are short term, then capital preservation becomes very important. So my asset allocation needs to be a bit on the conservative side, right? So let's say if I have equity, fixed income, and gold in my portfolio, then maybe I will do a 50-50 allocation, 50% to equity, and let's say 35% to fixed income and 15% to gold. So it's like a moderate to conservative kind of asset allocation. The idea is that even if the market crashes, I will not lose a lot of money. I will still be able to meet my goals, right? And on the upside, if the market does well, I will do reasonably well. And if I have a longer term goal, let's say I have 10 years to reach my goal, right? I'm saving for my daughter's higher education. Then I can afford to be a bit more aggressive, right? In my asset allocation, I can keep 65 to 70% allocation to equities, maybe 15 to 20% to fixed income and 10% to gold, right? Because that gives me that enough time to recover from any market corrections, right? So to summarize, if I have a short-term goal, I need to be a little bit more conservative in my asset allocation. And if I have a long-term goal, enough time on my hands, then I can afford to be a bit more aggressive and have higher equity exposure.
Thank you, sir. And it's the right way to put. With that answer, probably I'll go back to the audience questions. I've seen a lot of questions which is coming on the personal front. Friends, we are sorry, those personal questions I may not be answering. And no, probably some of you can write to me separately. And some of the schemes and fund related, I will not be answering. And Mr. Madhusudan, probably regarding your MAF and BAF, we have taken during the question answers. And other question on ABSL MF. I am not commenting here because it's an investor education initiative. Probably I'll have a separate call with you and I can address to you. And thank you, Mr. Dr. Satyaprakash Mishra ji. I mean, he's asking me to write a book on acronyms. Thank you so much, sir. And which is also a suggestion from Amit ji. And I look forward one day that is an inspiration for you. And like somebody anonymous attendee on our mobile invest capital any call number not responding, probably if you have something, please write to me. I will take it forward to the right guy in our system, either at ABSL MF or the capital, whatever. My email ID is ks.rao@adityabirlacapital.com, which is available on the mail which you have received. Please write to me. It is my responsibility to get it answered. And regarding today's recording, Mr. Praveen Kumar, it is available on the it's playing on the live on the Facebook live, and later our Manorama team will be putting on the YouTube channel on this. And then Amit ji, but there is equally BAF assets, the theory only, BAF and MAF again, Madhuji, Masudanji, we have answered that. I think Amit ji want to share something.
Yeah, sir, I just want to add there that it's not always possible for a mutual fund company to manufacture all sorts of solutions. And a lot of times we have to put multiple funds together in the portfolio at our level and arrive at our own balance. So that's why whatever the mutual fund company creates in the fund, that would be clearly spelled out in the scheme information document, and you can check it on the fact sheet also on a regular basis. So fund house would tell you that this is what I'm going to offer. Now, if you think that that is not satisfying your need fully, then you may need to add some more components and create your own portfolio. This is another role where a good advisor can help you out, a good mutual fund distributor can help you out.
Thanks so much, Amitji, for that, and hope Madhusudanji we have clarified on that. There is one anonymous attendee. This question I'll put it to Vinodji. This is a generic question. This is talking about are there any books for the young adults who could read and attain more knowledge and sensible for wise as well? And incidentally, friend, these two gentlemen have written wonderful books. Probably read both, and it is like it gives a lot of wisdom. But over to you, Vinodji. Anything you would like to suggest?
Yeah, I would definitely recommend one is, I've written a book called The Financial Independence Marathon. And I was motivated to write that book looking at the experience of my own family members, friends, and relatives, many of whom do not have too much idea about investing in general, and they were not taking the right decisions, right? So that's the reason I wrote the book, and I've written it in the form of a story, making it an analogy to running a marathon, but explaining the concepts of asset allocation, personal finance, these different asset classes like equity, fixed income, commodities, real estate, and the various types of mutual funds, and how one can build a portfolio. So that is one simple, easy book that you can, refer to young investors to read. And I would also request Amiji to talk about the books he has written or anything that he would recommend.
So thanks, sir. So I've actually written 5 different books, and out of that, at the basic level, I would recommend the latest book, which is Money Wise. Though it is titled as Money Wise Perspectives for Women, it is not just about women. It includes the perspective from a woman's, it includes a woman's perspective about personal finances, but a lot of concepts about personal finance are applicable to everybody. So a good starting point. But more importantly, at the end of the book, we have put a bibliography of roughly 10 or 12 books and a few websites. So those are also very interesting resources for you to read. And all the books that we've mentioned, or all the websites that you mentioned, are Indian authors or Indian websites. And that was a conscious decision, because we did not want to put something which is written in another country's perspective or another culture's perspective. It should be applicable to us. So that's one thing. I would recommend. Apart from Vinodji's book, which is a phenomenal book connecting marathon with investing for life. And please remember, investing is for a very, very long term. And there, like in case of a marathon, stamina is far more important than speed. And stamina is staying through that entire race. So in marathon, when people like us run, it is said that it's not important to come first, it is important to complete the race. The same thing applies in case of money management. It is important to complete the race. So his book is another the fantastic book connecting those concepts. And the other book that I like a lot is Monica Halland's book called Let's Talk Money. Brilliantly written, especially for beginners.
Thank you so much for that. And with
Yeah,
this,
and one fine day when Rao sir writes his book using acronyms, I think that would be a recommended book. So look forward to that book.
Thank you so much, sir. Thanks a lot. Amitji, this question to you. This is not today's topic, but it is a question from Mr. Nageshwar Rao. He says, can you throw some light quickly on ETFs versus MF? In the meanwhile, I'll put through other questions.
Sure. So ETF is actually a mutual fund scheme. It is just that it is exchange traded funds, which means the units of the mutual fund are traded on the stock exchange like the shares typically trade. As against that, a typical open-ended mutual fund, you transact. When you buy from the fund, and when you sell back to the fund. So the counterparty is always the mutual fund. In case of an ETF, there could be one individual who's buying and the other individual is selling. The fund does not get involved in those transactions. Now, because of that, in case of mutual funds, open-ended mutual funds, the transactions happen at a price which is related to the NAV of the day. And this NAV of the day is calculated once. Whereas in case of ETFs, when two different individuals are transacting, there is a market price per unit on a daily basis, and that market price typically remains closer to the NAV. Now, in ETF, because the transactions happen throughout the day, generally, most ETFs, at least in India, most are linked to an index. So as the index prices go up and down, the NAV can be also calculated with a good precision on a real-time basis. And the market prices are very close to that real-time NAV where the transactions happen. Again, there are a few other complications where sometimes the prices may be away from the NAV, but that's the nature of the market where these things do happen. But ETF is one where, because you are transacting on the market and the fund doesn't have to, the fund can keep the portfolio fully invested and it need not have cash. It may have by choice, but it need not have. Whereas in case of open-ended funds, to manage the inflows and outflows, the purchases and redemptions, some amount of cash may be required. The expenses happen at two different levels. In case of open-ended mutual fund, all the fund management related expenses are charged within that total expense ratio. Whereas in case of exchange traded fund, apart from the fund related expenses, when you transact, you also pay the brokerage to the broker, plus whatever little charges you may have on your demat account, etc. Those are on you. These are primary differences between the two. But otherwise, ETF is one type of a mutual fund.
Thanks, Amitji, for that answer. For the rest of the questions, some I'll do quickly. This is a question from Mr. Maitra from Kolkata. Mr. Maitra, probably the first question of yours, two questions on the CAGR and shifting from the X fund to Y fund, equity to debt. This allocation, I advise you can be with your advisor, or you can take this in the small conversations. It's not right on our platform to do. And second question for you is a mix of there is a mixed platforms where you can get DMAT, FinTech, and all these platforms. There are single platforms which are available now. There is an execution only platform is coming in. There are other platforms like either in the Morningstar, Money Control, or Value Research. You have these platforms where you can put your PAN number, you can get all your investments done, and you can evaluate at one go on those single platforms. And Mr. Tejeshwara HM, and investing in the lump sum or debt funds or fixed income. Any scheme lump sum is always possible, and debt funds you can don't look at anything. You can always put the lump sum, and the mutual funds any day you can invest your money into the mutual funds. On the equity side, if you want, you can use the STP or SWP mode over a period, or lump sum, whichever the one you can use. Probably get an advisor and get into according to your goals. You can invest. It is a better way to look at it. Tarun Singla, one single mutual fund that has given a best return and expected to give the same, mutual fund advertisement. Probably you have not read or you have not heard solely. Our past performance is not equivalent to our future performance, and it's always you can look at some fund which has not done well today may do very well. Some has done may not be doing. And
Sir,
yes,
just one point I want to add out here, because this question frequently keeps coming. If I only knew the answer to this particular question, I would not be participating in such webinars. I would have completely retired very comfortably by investing all my money in that fund which is going to deliver the highest return in the future. So don't even expect the answer to this question. It's impossible for anybody to answer. That's number one. And if somebody claims to know the answer, run away from that person. The chances are either that person is ignorant or a fraud, and you better stay away from both. Now, when you don't know the future, what do? And that's precisely where you diversify across different schemes, different types of schemes, different asset categories, so that you get a smoother upward journey. It may not be the highest return, but it will be smoother and consistent.
Yeah, thanks, sir. Thanks for it. And probably other questions I'm skipping. Amitji, for you, Mr. Rahul is suggesting you should write a next book on stories on personal finance. Please do it, Amitji. That's a good suggestion. And some of those questions are purely whether I need to book the profit or not to exit. Those things which we are not going to take at this point of time, and it is not our prerogative or prior, or we are supposed to do that. I mean, most of these questions we answered, other left out. Just I'll go through a little later and I will mail you some of the answers where it is possible. With this, each of you, I thank for joining us. And end of it, this is about sticking to the basics of investments, basics, the fundamentals of investment means sticking to your financial goals and optimizing on your asset allocation and staying remain disciplined is the most important stuff. Whichever the market cycle you are, and continuing with your SIPs and increasing your SIPs is one where you can look at the fundamentals of investing and keeping your emergency funds like which is a must, and where you can use your surplus to use our liquid funds, and getting the financial advisor, consulting your financial advisor is the basics apart from looking at, and that is the fundamentals. With this I'll stop, and I sincerely thank Vinod ji, Amit ji, and I'll hand over to Mr. Matthew. And I thank all the audience for joining today and spending your time. And we wish you all happy investing. We'll come back with the next month onwards. We are thinking to do series of sessions on the retirement planning and the financial independence. Probably every month you are going to see a different topics on the retirement, because which we feel that is going to be the most important part, whichever the age, whichever the cohort you belong to. Please keep watching us on Manorama social sites, where we are going to announce our association with Manorama. And we are also doing a lot of on-ground events with Manorama team, and starting with Chennai, which will start, and which is also going to be. In addition, from at Aditya Birla, we have a lot of other engagements which are coming in. Come to our website. We have recently started Fingo. It's a financial investment on the go financial game. You can do a lot of learning through the gamification. We have a platform for exclusively for women, which is called For Her. And we are also doing series of sessions in various universities, which is called My First Paycheck, which is going to become a big workshop model. I mean, encourage your children to join there in their colleges, which we are doing. And last but not the least, and Amphi is going to do a fabulous stuff on 77th Independence Day celebrations. We are reaching out to little over 77,000 schools. We are running a essay contest. It's a marathon essay contest, which we'll call Financial Shikshit Bharat Banega Vikshit Bharat. And it's a lot to consume, lot to educate, lot to get empowered. All that we need to look at when India is getting into the prosperity. It is you should not miss to become prosperous. Wishing you all the good luck, and over to Mr. Matthew, sir. And thanks to each one of you, and God bless you all.
Thank you. Thank you so much,
Thank you.
Mr. Rao. Let me begin by adding my appeal to Satprakash Mishra ji's appeal and Amit ji's appeal on bringing out the book on acronyms. This is something
Yeah.
that you aced that game. I'm sure there'll be a lot of people who would want to read it and will widely appreciate it. I know that there is a huge demand on your time, but still, it would be a great help and a blessing if you find a little time to do that for all of us.
Maybe I
So,
take a second of you for a request. I will
yes.
write the book, and I request Manorama to help me to publish.
Sure, 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 sure. Why not? Why not?
It
Why
will
not?
become Mani Rama then.
Why not?
Manirama.
Why not? Okay, let me not keep the audience as Mr. Rao is always on the clock, and it's exactly at 12 he stopped, very punctual. And I always thank the Alti Birla family for putting together a panel that's very ethical. You notice that Mr. Rao refused to answer questions, even those regarding specific ones to the fund, while both of them, Mr. Rao and Mr. Bhatt, both are very well qualified to answer all those questions. This is an investor education program, and they usually don't do it even on ground events. They never do it. So thank you so much, sir, for all that and for setting a role model for everyone. Thank you so much, Mr. Rao, Mr. Bhatt, and Mitji. Thank you so much for being with us. It's a pleasure to see you all this morning, and thank you to all our audience. Please stay with us. Come back, and as Mr. Rao said, please look at the week social handles. We'll be putting up all our news about when this panel will come back again. Thank you so much. God bless, and enjoy the rest of your Sunday.
Thanks once again. Thank you
Thanks.
all.
Thanks.
Thanks again. God bless you all. Thanks for your time, Vinod ji, Amit ji, and thanks, Matthew ji. We'll
Thank
catch
you,
up
sir.
later.
Thank you.
Thanks.